Okay, here we're going to look at the situation where the parent corporation here has inventory that it purchased here from the subsidiary corporation, and they have a beginning inventory here of $80,000 at the start of the year. Now that's the inventory that was carried over from the last year that was purchased here from the subsidiary corporation. And then they also have an ending inventory. In this case it's $60,000 here. That's the remaining inventory after all the sales that were made from the parent corporation to the outside sales here. So we've got both a beginning inventory here of $80,000 and an ending inventory of $60,000 that we have to deal with. And for the year here, the subsidiary corporation made sales of $240,000 to the parent corporation here. So they made sales of $240,000. And then the total sales that the parent made to the outside sales here was $260,000. So that was the total amount here of the $80,000 plus the $240 plus the $60. They sold $260,000 worth of that. So that leaves an ending inventory here of $60,000. Okay, now we have to determine the profit that's sitting here in the parent's inventory account for both the beginning inventory and the ending inventory. And that profit is going to be based on the cost of goods sold here and the sales that the subsidiary makes to the parent company. So let's go down and make our calculations here. So Corporation S had a profit on the sales to Corporation P, our parent corporation, for the year, and those sales here to Corporation P were $240,000. Now the cost of goods sold on those sales here to the Corporation P, or the parent here, was $192,000. So the difference here gives us a profit of $48,000. So our gross profit rate here would be the profit here of $48,000 divided here by our sales of $240,000. So that gives us a gross profit rate or margin here of 20%. And that's what we're going to use here for determining the profit that's sitting in the beginning inventory and the ending inventory here for the parent based on their purchases here from the subsidiary. Okay, now that we determine the gross profit rate here on the sales from the subsidiary to the parent, we can determine the profit here that's sitting in the beginning inventory and then the profit that's sitting here in the ending inventory. And then knowing that profit, well, we'll have to eliminate the profit here for there's intercompany based on the intercompany sales between the subsidiary here and the parent. So we'll go in and calculate our eliminations now. Okay, now to calculate the elimination here of the intercompany profit here contained in the corporation or the parent's beginning inventory account here of $80,000. And for our example here, the parent is going to have an 80% ownership, and then the subsidiary, the non-controlling interest, gets a 20% ownership. That's for our example here. So to determine the profit here that's sitting in the beginning inventory, we take the gross profit rate here that we calculated of 20%, and we take that 20% here, that gross profit rate, times the beginning inventory amount here of $80,000. So we have $16,000 worth of profit here sitting in the beginning inventory. And then for our elimination entries here, we would divide it up this way. So the retained earnings at the beginning of the year of X1 here for Corporation P, they would get 80% of that profit of $16,000 here. So that would leave them with $12,800 here, and that would be a debit amount here to the retained earnings at the beginning of the year for Corporation P. And then the retained earnings at the beginning of the year here for the subsidiary corporation, they get 20% of that $16,000 of profit here. That would leave them with $3,200 here, and that would be debited here to retained earnings for the a subsidiary corporation at the beginning of the year. And then the balancing amount here would go to the cost of goods sold for the second year or year two here. That would be credited here for $16,000. Okay, to follow up with our eliminations here. Now this profit here is shared with the non-controlling interest or the subsidiary, since the selling corporation was the subsidiary in this case, or the non-controlling interest. If the parent corp had been the seller, only the controlling interest here of the parent corp or its retained earnings retained earnings would have been decreased. Note that the profit here of $16,000 is shifted from year 1 here to year 2, since year 2 is the consolidated cost of goods sold, and this is reduced by $16,000 in this case. So the intercompany inventory profit is not eliminated, but only deferred until the inventory is sold to the outside. Okay, next we have to eliminate the intercorporate profit here recorded by the subcorporation S here for the goods that were contained here in the parent corporation's ending inventory of $60,000. So going down here, our gross profit rate, of course, was 20%. So the profit that in the ending inventory would be 20% times the $60,000 ending inventory for $12,000 here. So what we'd go up, our entries would be to debit cost of goods sold here, or increase it for $12,000, and then reduce our inventory account here for $12,000. And then finally we have to eliminate any intercorporation sales to avoid any double accounting here. So we'd go up here to the subcorporation sales here, subcorp S's sales, and debit that for $240,000, and then we'd go over to the cost of goods sold here and credit that for $240,000. Okay, now for our consolidation worksheet entries here. First, for the elimination here of the beginning inventory profit here. So we'd go here to the retained earnings here for the beginning of the year, January 1st of X2 here for the parent corporation, debit that for $12,800, and then the retained earnings here for the beginning of the year of X2 here for the subsidiary corp here, debit that for $3,200, and then the balancing amount here would be a credit to cost of goods sold for $16,000. And then next, to eliminate the ending inventory profit here, so we'd go up here toward the inventory account here at 12/31 X1 of the beginning of the year, we'd credit that for $12,000, and then our cost of goods sold here, we would debit that here for $12,000. And then we have to eliminate the intercompany merchandise sales here to avoid any double accounting. So we'd go in here and we would debit sales here for $240,000, and then we'd credit cost of goods sold here for $240,000. And then we have one last entry here, and that's to get rid of our intercompany debt here, the accounts receivable and accounts payable between the parent and the subsidiary here. So we would go in here and we'd credit our accounts payable for a receivable, excuse me, here for $120,000, and then we'd go here and we'd debit accounts payable here for $120,000. All right, now to determine the income, and starting with the subsidiary corporation or subcorporation S, they had an internally generated net income here of $120,000. Then they had a realized profit on the beginning inventory of $16,000, and then there was an unrealized profit here in the ending inventory of $12,000. We would subtract that out here, and then the adjusted net income would be the sum of these here for $124,000. Now the non-controlling interest share in this example was 20%, so we take 20% times the adjusted net income here, and then the non-controlling interest income here would be $24,800. Now going over here and looking at the parent corporation's income here, so they had internally generated income here of $140,000, and then they would be receiving 80% of the subsidiary or corporation S's adjusted net income here of $124,000, and that would give them $99,200. So the sum of those amounts here were giving the controlling interest or the parent corp $239,200 here in net income.